video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all.
Alright, hello and welcome to Camel Finance. I'm your boy, Camel. And today is the weekend's deep dive. On the weekend, we like to come back and re-examine the base case hypothesis of the channel that we have held pretty much since its inception, which is getting on for 3 years now. And as ever, we're going to run through this thing from the top and see if, largely speaking, things are still going according to plan. Just before we get into that, of course, today is the official launch of the Slice 1-to-1 upgrade feature. It is, of course, limited to 15 spots to make it manageable. I already know it's going to be massively oversubscribed, so best of luck to all of you. There's a link in the pinned comment and description if you are interested. And without further ado, let's get into today's episode. So the base case for the stock market was pretty simple. At the lows, I was saying that we were too bearish. We would probably have a blow off top to all-time highs and then come tumbling down in a global bear market and recession. And the key part of this idea was that for a short period of time, we would slip into asset price deflation. Fast forward to today, and I think we can make a pretty compelling case that the risk is higher than ever here. We did have a blow off top with 3 increasing angles. We violated the third and the second angle, confirmed it with a failed daily cycle. This, for me, said that the top callback here when we went flat before Christmas was correct. It also said to me that the trend change is likely in place and becomes the base case until such time as we can invalidate it. And also for a long time I've been warning about this bounce to a lower high before moving down towards new lows. As it stands, we're very much at an inflection point right now. We know we've got an upcoming daily cycle low. Once that cycle low is in, all the while it holds, it is malpractice to be bearish and we can remain cautiously optimistic here to get an invalidation on this top call setup and see new all-time highs come in. But once that daily cycle low is in, if it were to fail, then that 100% confirms this was the lower high, and it's only reasonable to expect the onset of a bear market. In fact, by the time this failed cycle occurs, should it occur, then that will be it. There will no longer be any rational argument to say that we are not in a confirmed bear market and downtrend. If you're brand new here and you don't understand cycles, then there is plenty of resources on the channel for you to go and learn, including a tutorial playlist, a PDF, and all that kind of stuff. So go and learn the rules, otherwise this is not going to make a great deal of sense to you. But for the majority of the Camel Crew, you know exactly what I'm talking about here. The upcoming daily cycle with failure truly confirms this trend has broken. However, if it can hold, then there is a chance here we can run to new all-time highs. And to give you an illustration of what this might look like, right here you can see the indicator has selected the window for us to find a daily cycle low in. Once we get here, it will pick a daily cycle low, and then so long as that low holds, like I said earlier, we can remain cautiously optimistic. But if that low, once it's in, then fails the cycle by closing a daily candle below it, then that's it, it's over. Right? It's literally over. So it's been a long time coming. It's not, of course, what I want to see. What I want to see is this cycle hold. I want to get long out of this cycle low and hope that we can see right translation and a new move to all-time highs. I want to invalidate this whole setup, but the market will need to prove that to me as always. I should imagine by the time we get long out of here and we get to around day 9, I will be looking for left translation and maybe even getting some shorts on to hedge the downside there. But so far, so good, right? If we're absolutely honest, we called for a blow off top and a breakdown, and that's so far what we've got. Now, again, there's always a chance, okay? If I'm going to play the advocate here, there's always a chance it could be this bear trap before the final blow off top, and it may look something like this, okay? If so, then the upcoming daily cycle low will hold. It will not fail. But really, it all comes down to this cycle low, and until such time as we've seen that cycle low, then I think it's premature to make any kind of judgment calls. I know people often seek certainty in an inherently uncertain environment, but the absolute truth of the matter is nobody knows, okay? Nobody knows whether or not this cycle low is going to fail or is going to lead to new highs. We can all speculate, we can all pick one outcome and have a 50-50 chance of getting it right, and then if we were right on the coin flip, we could come back and say, I told you so. But the reality is no one knows, right? The risk is high, and any kind of judgment prior to seeing the cycle low is premature. So we're going to continue to do what we always do, which is wait for the cycle, trade the cycle publicly on the channel, except this time, because I believe the risk is elevated, because I believe there's a very good chance we do confirm this as a lower high, I will probably get hedged short somewhere around day 7 to day 9 in the daily cycle. So stock market, not looking too bad if you ask me, seems to be more or less playing out as expected. Now, the next part of this base case is that Bitcoin was going to form this weekly cycle low and double, simply because that's what it's done out of every other weekly cycle. We went approximately 100% off the weekly cycle lows, and you can see that all of these are equidistant, right? They're equally spaced apart. There's a couple of weeks wiggle room as always, but I was speculating we'd probably find another weekly cycle and then look for another double out of here. And an updated look at this chart on the weekly time frame shows you that actually, things are still more or less going according to plan. I don't see any reason to start to doubt this just yet. And in the weeks that we were carving out a bottom here, I was covering on a near daily basis that many people had quit. Retail participation had moved down below bear market lows. And I was going live and begging people not to quit the space. And the reason I could be so confident is because of how consistently reliable these weekly cycles are. So we've got the weekly cycle low in. It only seems reasonable until the market proves us otherwise to assume we're getting at least a double, if not more, out of this current weekly cycle, which sets us up for at least 150k. And I am speculating, based on the profile of the 2017 cycle, that we may get significantly more than 100% out of this double as well. Depending on how long it takes to complete the double and hit the target, depends on whether or not there'll be enough time left in the major 4-year cycle to get yet another weekly cycle low and double thereafter. But again, so far so good, right? We publicly got in at the lows. We have held this position without cheating any of the bag. And if we can just get out close enough to the top to call it the top, then again, I think this is another one we can tick off and say mission accomplished. And then of course the focus will become on once again getting in at the lows at the 4-year cycle low, just like back in 2022. As I said at the start, a major component to this bear market, if it is going to set in now, if we are going to confirm it, and if we're going to start to head to new lows, is that ultimately we would have a short period of asset price deflation. This whole idea was predicated on the fact that anything you do to the M2 rate of change shows up in the CPI with a lag. For an updated look at this chart, you can see that most of this M2 rate of change has played out, but I still make the case that we are missing that final move lower towards a period of asset price deflation. And I know, as we're going to show you in a moment, that trueflation has been ticking up, right? This looks like a bottom and a turn in inflation, but I'm still making the case that just like people were calling for a resumption of inflation here, and I was saying, no, this is a counter-trend wobble within the primary downtrend, I still think that's what this is. Especially if we are going to get a confirmed lower high, a failed cycle, and a move to the downside here, then there's no faster way to kill inflation than to have a stock market crash and an economic contraction. Either way, after such a massive move, I mean, this went from 3 to about 1.2% in about 4 months. Okay, so for that kind of a move to unfold, it only makes sense we're going to get a snapback, and I believe that's what we're seeing here. But make no mistake about it, I genuinely believe we are going to see resumption of the downtrend, especially as we're starting to get towards the neighborhood where we should see that shelter component come home to roost. Shelter has been the biggest laggard component. The way it's calculated is a little bit spurious, and using real world metrics like ALNRI, we know that shelter has been deflationary for over a year and a half. So we've been seeing cold prints, happy days there. We've also been getting core PPI coming in, deflationary month over month for 2 consecutive months. And so I continue to make the case that the primary trend is a disinflationary one, and that the risk is still deflation later in the year rather than a resumption of inflation. We also know that we had the Q1 GDP data come in weaker, again indicative of a slowing economy, and we continue to see labour market deterioration in real time. And this brings us on to the next component of this base case hypothesis, which is, if we are going to have a bear market and a global recession, then it's only reasonable to expect labour market deterioration. And that's, of course, what we've been seeing. Now, in the same way that no stock chart or commodity chart or macro data set moves in a straight line, there are pullbacks along the way. This has been a plenty volatile macro data set, but the overall trend is clear. When we look at the amount of jobs added, this is quite clearly a gradual downtrend. When we look at the 6-month moving average, U6 for the unemployment rate, you can see this thing is continuing to move higher and higher and higher. And whilst it has pulled back by 0.2% in the past 2 prints, we are still sitting at a level that looks an awful lot like a lead-in phase before that accelerative pump synonymous with recessions. That's what we saw in all prior instances. So this can change, and I would love to see it change. I would love to see this thing turn down, start to print new lower lows. But until such time as it does, then again, the risk is still elevated here. And we're just a couple of weeks away now from getting the next monthly print, right in time for the 6th of June cycle lows, I might add. Okay, I just noticed that now. If you know, you know. But once again, this Sahm recession rule, okay, I would love nothing more than to see this thing make a new lower low, to change its market structure. That for me would be brilliant, okay? Then we could start to say, okay, maybe this was a false dawn, a false alarm, a false signal. But as it stands right now, this still also looks like a lead-in before perhaps a acceleration to the upside, just like we saw in prior recessionary periods, okay? They all start with that lead-in before that accelerative pop, and the accelerative pop is synonymous with recessions. So until such time as we print a new lower low, then what we objectively have is an uptrend of higher highs and higher lows until proven otherwise. Again, telling us to keep an open mind about the risk being elevated here. All of this sits against a backdrop of having a 94% probability of, again, seeing no further rate cuts at the next FOMC. I continue to make the case that this is overly restrictive, since we know inflation has been coming down and the Fed's behind the curve. We also know the labour market is gradually getting worse and worse, albeit at quite a slow and steady pace. As I said earlier, we know we've got these lead-in phases, perhaps before acceleration in things like U6 and the Sahm recession rule. But unfortunately for the Fed, it does not seem to want to take any of this into account and is simply being pressured by the capitulation in the bond market, and therefore is in no position to cut rates at the moment. As this story develops, we are currently seeing the Fed toying with the idea of having to print money to be the buyer of last resort for its own debt. This could indeed force the 10-year yield and the 2-year yields lower, and that may finally allow for the rate cuts to be put on the table. But as it stands right now, we continue with this overly restrictive policy, which may well lead to financially stressed conditions. Now, having said that, we have been following the high yield credit spreads. Okay, when these things break out and spike, they tend to do so without looking back. And these are, again, synonymous with financially stressed conditions. If I scroll back, you can see the breakouts are synonymous with recessionary periods. So recently, we did indeed get a breakout and a big spike. And I was saying this should start to ring alarm bells, particularly because it's against the backdrop of the stock market breaking down. Since then, we've had a big counter trend bounce in the stock market. And of course, the high yield credit spreads made it all the way back below the trend line. Now, what I really need to see, and what you really need to see if you are a bull champion in new stock market highs, is this blue line here, the high yield credit spreads, continue to move to the downside. Okay, if this turns out to be a breakout retest and then resumption here, that to me would speak to this being breakdown, retest, and resumption of a bear market in the stocks. So the risk again is elevated. We've certainly undone a lot of the damage with this counter trend bounce that we've seen here in the stocks. It's certainly a good sign that we made it all the way back below the trend line for a while. But again, okay, we are still at risk, because if the stock market is going to continue to break down, then this starts to spike. This will pretty much just be confirmation that that top call back in January was totally correct. And again, we know under the hood that bankruptcies in the US are skyrocketing, and outside of 2020, this is the highest level since the GFC. We also know that there's 6.1 million Americans in default on their mortgages. We know the car markets and auto loan delinquencies are hitting rates not seen since the GFC. We know that delinquency rates on credit cards for banks outside of the top 100 is now higher than the GFC. So we've got this have and have not economy. Whilst a bunch of people were walking around richer than ever because they bought Bitcoin and gold and had assets and were positioned correctly for the printing off the back of the C19 era, the reality is most people are not, okay? The other half of the economy is living paycheck to paycheck, defaulting on their mortgages, can't afford to pay their credit cards and auto loans, all at a time when we're seeing continuous and gradual but steady labour market deterioration, with a Fed that is overly restrictive in its interest rate policy and behind the inflationary curve, with, of course, the stock market having lost its third and second angle, confirmed with a failed daily cycle, and now perhaps working on a lower high confirmation. Now, unfortunately, we're not going to know, right? Because it's going to take a few more days to work out cycle low. Once that cycle low is in, it becomes the hard invalidation. Trade below that low, as I said earlier, and that's it. It's over. We're certainly in a bear market. But there's still a chance after we find this cycle low that we can invalidate all of this. We can see things like the Sahm recession rule print a lower low, start to take some pressure off there. We can see things like the high yield credit spreads come back below the trend line and start to base. Again, taking some pressure off there, removing some risk. Perhaps we can start to see inflation at the hard right edge start to normalize in here, okay, start to base and go sideways and be steady, contained right around the Fed's target. And perhaps all of this can lead us to that glorious blow off top moment where we get this massive push to new all-time highs in the stock market, where Bitcoin runs all the way up to multiple hundreds of thousands of dollars, and we all get to live happily ever after, having stayed on trend for as long as physically possible. But of course, the caveat to all of this is if things don't change, okay, if labour market deterioration continues to present, if the Fed continues to be overly restrictive, if the stock market can fail its upcoming daily cycle and start to move to the downside, with the likes of the Sahm recession rule spiking up, confirming that that was a lead-in before acceleration, with the like of this being confirmed as breakout retest resumption, then again, okay, the writing is going to have been on the wall the whole time. We've been doing this every single week for about 3 years now, and we're finally at that part of maximum risk. Now, of course, I'm not cheering on a recession. I do not want a recession. We're going to make far more money if this cycle low that I'm about to long out of here just on the off chance turns out to be correct, right? I would love nothing more than to see this thing move into that big blow off top moment. We'll make so much more money versus if we enter a bear market. But the reality is to just sit back here and say there's nothing wrong under the hood, everything's fine, all the bears are idiots, that kind of thing, right? It is simply careless capital management. It's simply a careless approach towards risk management. You have to be open to all possible outcomes here. And if this lower high does confirm and we do move down towards a bear market low and a new low below this low, well, it's going to have been pretty obvious, right? You're going to be in a hard place to say, oh, I couldn't have seen that coming. This was a black swan event. How could anyone have known, right? The writing is right there on the wall for everyone to see. All you have to do is be open to all possible outcomes. You can see I clearly am. I continue to want to long this cycle low and cheer on the idea of a new blow off top and a new push to all-time highs. I continue to be positioned long after doing a whole heap of dip buying during the spill. I continue to push those trades in the longer term accounts. I continue to add more positions in the level 3 member section. I still have not sold a single sat of Bitcoin from the spot position we acquired at the 4-year cycle lows. We've been making these videos day in, day out. I make 6 videos a week plus 1 for the level 3 members. And I think it's fair to say nobody wants to see new highs more than me. Again, based on everything I've shown you so far, there are plenty of risks and warning signs out there. And I do think a cautiously optimistic approach is the best approach right now. The last thing I like to point out before we hop into a few charts and head for some position call outs are the yield curves. And when we check in on this, okay, so far still looks like a continuous chain of higher highs and higher lows, doesn't it? Now, I would love to see this thing move to the downside. If we can do this, particularly after finding that daily cycle low, it would speak to removing, again, a lot of the risk, similarly to seeing this thing trade back down here and everything else I mentioned. But if we are going to start to confirm a lower high, it's only reasonable to expect this thing to pop and for all of this to have been the heads up signal in the first place. Now, when we go to the 10-year, 3-month, again, we continue to chop in that range, which is what we want to see, okay? This is a point in the bull's favor. This does not look like a big accelerative sweep that we are used to seeing during financial meltdowns, like here's the dot-com bubble burst, here's GFC in 2008. Doesn't look anything like this 3-week candle pop of around 783% in 3 weeks, right, that we saw during the C19 era. Doesn't look anything like this so far. So this is good, okay? But like any market, it can change very, very quickly. If it is going to change and we do start to see this, especially after having found a cycle low and then moved up and failed, okay, left translated in the daily cycle, rolled over and failed the cycle, then again, you're going to be hard pressed to make excuses such as, well, nobody could have seen this coming. This is a black swan. Well, this is all because of some president that's doing tariffs or whatever. The signals are all there. They've been there. And now it's our job to really pay attention and see how many of these risk signals can either deteriorate or disappear. So by now, you should know what we're looking for in the stock market. Okay, we're looking for that daily cycle low. We're going to get long out of here, and then we're going to see what the market has to give, right? Does it have new highs left in it? If so, we'll be positioned to catch that blow off top. And if we get a day 9-ish left translation and start to head down towards the cycle low, looking like we're going to fail, then it will only be reasonable to get short here. Okay, and it will look like this, I would imagine, with the yellow squiggle, of course, heading down for cycle failure before ultimately looking for new lows. I do want to emphasize one more time, a lot of people look for certainty. They look for people to tell them exactly what's going to happen in an inherently uncertain world. That's not what we do here. We allow the cycles to guide us. We allow the cycle lows to become our hard invalidations for setups, and we stay objective, right? We stay disciplined, we stick to the system, and we continue to manage risk accordingly. For gold, we've been long out of this daily cycle low after the camel cycle low indicator picked the low. I've been saying the same thing over and over again. It would be unusual to work out a weekly cycle. You can see it's not yet confirmed as a weekly cycle as well, although we are well overdue for one. For the camel indicator to pick this as a weekly cycle, we will need to break this trend line. If we do so and the camel picks this thing as a weekly cycle, then I've been speculating it might be about to get insane for gold. Something like this. This is why I'm positioned long and the actual target is much, much, much higher up. But I've also been consistent in saying if this is going to reject a resistance here, okay, or show us a fake breakout and roll over, then once again, we'll have to head into this daily cycle low window that you can see highlighted in green here. So it will look something more like this, perhaps. and we'll cut this trade prematurely. We'll wait for the camel indicator to pick this as the daily cycle low. By the time we get here, it will also be looking for a weekly cycle low, and then we'll look to confirm the weekly cycle lows in with a trend line break. We'll be long again, and I expect much higher prices. For Bitcoin, still no change to the plan, okay? We were talking about getting a top for the daily cycle around day 45. So far, I think this occurred on 45 or 46, and now it's only reasonable, for me at least, to expect us to start to head down to a daily cycle low, where again, we'll be getting long, sticking to our system, trading the cycle lows, using that cycle low as hard invalidation, and looking for that continuation of upside as we approach that 150k plus neighborhood that I've been showing you over and over again. Of course, in the level 3 members section, we will be adding more crypto stocks as always to extract further beta from this market. And of course, they will be notified in real time as always when I pull the trigger with the exact levels for entry and stop loss. I'm also noting here the Dixie is working on or approaching what looks to be weekly cycle failure coming up. This is crazy bullish for risk assets. I can see this thing, if it can fail this cycle, heading way lower. We're still quite early in the 3-year cycle, but what tends to happen in a bearish Dixie cycle is we see approximately a year to the high and then 2 years in a downtrend. So is that what's coming for the Dixie? It was not my base case at all. I really thought this thing would break out and we would get a big push here, but it looks like it's working on a failed weekly cycle here. And if that cycle fails, then it implies we're going to be in a downtrend to at least the next weekly cycle. And the last thing I want to cover is the 10-year yield, okay? So I was talking about really wanting to see this thing not print a higher high. It has printed one on a marginal basis. And I was saying we really need this thing to top right here, right now and head down. Otherwise, we're going to have to put the situation on the table where the yields run and the Fed may be forced to step in and print to be the buyer of last resort for its own debt. So I hope that what we're about to see now is the 10-year head lower. That will start to put rate cuts on the table and we can continue to jump up and down and say tell that to the bond market. But I still think, again, this is one of the biggest risks that we have at the moment. And again, it's going to require us to continue to take things one day at a time. So if you're a level 3 member, look out for the members only video I'm about to post for you guys. If you're new here and made it this far, consider subscribing, follow along as we continue to track this base case on a weekly basis in real time, week in, week out. And in the middle of the week, we continue to post daily content and trade setups as always. Other than that, I'm your boy Camel. Have a great weekend. Until next time, all the best. Cheers. Bye.
Camel Finance, he's the man to see. Rocking the markets with his contrarian spree. Trades like a pro, no fear, no shame. Sticking to his guns in his money game. He's a badass, oh yes indeed. Camel